What is the ABC strategy? I'm going to go through it briefly, then I'm going to give you 3 examples. Okay, I'm going to show you how we use it and how you can start using it in your trading. So the math behind it. Take your strategies, all of them, from the best to the worst, line them up. Okay, so your best strategy, number 1, your second best strategy, number 2, and your worst strategy, number 3. Okay, line them up in terms of expectancy. If on strategy 1, I make $100 typically, strategy 2, I make $20, and strategy 3, I lose $35. You line them up. Okay, and the way you want to think about this, your A strategies are your best strategies. They have the most expectancy or the most likelihood of winning. Okay, your B strategies, they're good strategies, okay, but they're not your best strategies. They're structured in nature. There's logic behind them. You know a lot about them. You've done a lot of them. And your C strategies are pretty much just your gamble trades. They're your trades that you pretty much lose money on, but you want to take them. You want to execute them because you feel like maybe you're learning. You feel like maybe you're engaging in the market, whatever it may be. Okay, so you list your strategies in terms of A strategies, B strategies, and C strategies. Now, you need to allocate. In other words, we spoke about a daily stop of $200. Okay, in this example, sorry, I'm going to use the daily stop of $500. Okay, so we use a daily stop of $500, and all we say to ourselves is, if my A strategy comes along today, for that strategy, if it happens to play out today, I'm going to risk $250 of my $500 on that trade because it's my A trade. Okay, so I'm risking 50% of my daily stop on that one trade. If my B strategy comes along, I'm risking $125 of my $500 daily stop. Okay, in other words, I'm risking 25% of my daily stop. And my C trades are effectively my worst trades, and I'm going to risk $50 of my $500 daily stop on those trades. Okay, so I'm allocating more risk to my best trades, and I'm allocating very little risk to my worst trades. Okay, and that makes sense because probabilistically, we want to bet on things we understand. We want to bet on things where we've got some sort of asymmetry. We want to bet on things where we feel like we've got a guaranteed winner in play. Equally, why would we risk on gamble trades? Why would we want to throw away good money at trades that we like? We like the idea because we read a tweet on Twitter. Why would we throw good money at those things that we have got very little understanding of? Okay, and that's why the strategy proves so popular for day traders, because ultimately our job is to trade, our job is to engage with the markets, and we want to make sure that we're allocating more risk to what works and what's good and less risk to what doesn't. Now, like I said, the way to think about this, your A strategies are the kind of trades where you feel like the odds are very much in your favor. Okay, as in, if you think you've got a 90% likelihood of winning on that trade, that's an A trade. Okay, it's almost an extreme. Okay, you don't see A trades all the time. They don't happen every day, possibly a couple of times a month. Okay, we've got asymmetrical skew. What do we mean by asymmetrical skew? In other words, when I hit the market, I'm very much going to go onside very quickly. Very little risk of going offside, very little drawdown on that trade, or what they call a sort of an unfavorable excursion, very much going onside. And when I do go onside, I'm going onside quite a lot. Okay, we'll talk about some of these examples in some of the a little bit later on. Okay, in terms of a B trades, those are your structured plays. Okay, they're plays that you understand, you know how they work, you know how to get in, you know how to get out. And then your C trades, when you're preempting, perhaps you don't have that much information, a little bit of a gamble trade, maybe you want a fun little scalp because, you know, whatever it might be, those are C trades. Okay, the key here is we take advantage of our best plays. Now, the example, okay, CPI came out last week. This was an A trade for most professional traders. Why? Because the month over month came out 0.1 high on the core and the headline. It was very much an outlier. The market was very much concerned about this. And as a result, this is where your entry price was. Okay, now sure, I'm not going to go into too great a detail. The point is that this is an outlier trade for professional traders. We want to be risking quite a high degree of our daily stop on this trade. We're entering there, and you can see there's very little. This is a 1 minute chart, by the way. There's very little price pressure against us. By the time we're entering, we're instantly onside, and we are looking for a relatively large winner before the market begins rotating. Okay, so in these trade scenarios, we want to risk a lot more. Now, a B trade strategy is something like a breakout strategy. Okay, you all have breakout strategies. These are structured plays. We know how to execute them. And this is the S&P 500 from this week. We can see we've got this little bit of a flag structure. We can see we've been consolidating from Monday, Tuesday. Yesterday afternoon, if you go look at the charts, you'll notice there was quite a high degree of absorption inside this candle. And all of a sudden, the market snaps, moves lower, and we drop from 74s down to 44s in about an hour, hour and a half. Okay, so a good 25-30 handle rotation. That was a structured B play. Okay, it's something we understand. We know where the stop is. We know what to expect in terms of characteristics. We know what we want to see in terms of volume. So we understand the play. And because of that, we want to allocate 25% of our risk to that trade. Okay, and then our C trades, and I'm going to take you through this a little bit later on, is when Brannigan comes out and says, look, you know, the pound is about to get pounded and you want to be selling cable on any rallies now because we should be going down to 121. If you like the idea, you like the fundamentals, you like the technicals, but you don't really understand the play, or perhaps, you know, you see it as something that, you know, it's not really your A or B play. These are the kind of trades that we allocate C risk to. Okay, it's not that we don't take the trades, it's just that we want to allocate a lot less risk to them. Okay, so that is the ABC and methodology, and that's how we determine ultimately which trades we put on more risk and which trades we put on less risk. Now, in terms of advantages, disadvantages, the advantages is that we take advantage of high probability outcomes. Okay, when it's in our favor, when the odds are very much leaning towards us winning, we want to risk more. Okay, it's very much a dynamic approach, but it also allows us to take on more trade ideas and learn with engagement. This is key for so many traders. You know, often I hear traders say, you know, sit on your hands and be disciplined. That's rubbish. Okay, you will only learn through applying yourself. You'll only learn through getting your hands dirty. Now, to do that, you've just got to manage the risk. Okay, which means engage in the markets, but do it so managing risk. Make it a C trade. If you're learning, learn through C trades. Okay, don't be putting on a risk for a trade you're still learning to develop. It's also a very flexible risk model. Now, in terms of disadvantages, it does require an advanced understanding. Okay, like I said, if you don't know your best and your worst trades, if you don't have some sort of idea of expectancy, you're kind of going to be flying a little bit blind here. All right. You also need to have some degree of back testing, and you know, at least in terms of maybe not a formal back test, but perhaps you need to have done a trade 10 or 20 times to understand if it's good or not. There is also, of course, a risk of foregoing trade opportunities if there's insufficient risk. Okay, what I mean by that is if you've gone and taken a trade what you thought was an A trade, but it turned out to be a B trade, you've given away a large amount of your risk on the day, which means you may not be able to trade for the rest of the day. Okay, and then lastly, there is the subjective nature of applying ABC. In other words, if I go back quickly to the ABC, I've recommended 50% on your A's, your 25% on your B's, and 10% of your daily stop on the C's. But this number is discretionary. This is entirely up to you. Okay. For the professional traders I mentor, I normally start them off on something more like a 10, 20, and 40. Okay, it's a little bit more conservative. Make sure that they still have risk. But again, this is up to you to decide. If you want to risk 100% in your day on A trades, fine. That makes sense. There's logic behind that. But just be aware of if you risk 100% on one trade and it's all gone, you are stopped out for the day.